The question today is, how does a fixed annuity work? And one of the things we're going to get into in this more of a beginner series is just kind of lay out the details of, what a fixed annuity is most like, some of the different types of fixed annuities, and then we'll talk about where I see some of the pitfalls and things that you want to avoid, and some of the good aspects of it that you can use to help protect your wealth. When I think of fixed annuity, one of the things I automatically think about is like a bank CD, right? Because a pure fixed annuity just gives you a guaranteed interest rate every single year. You're going to get the same guaranteed interest rate for the term in which you buy that annuity. So it could be a 3-year fixed annuity, could be a 5-year, 7-year, 9-year, right? They get out really long. And that's one of the things you want to be careful about is, how quickly will I need access to this money? Because if you lock up that money for a 5-year period, but you need access to it in the 3rd year, yes, you can take that money out, but there's going to be something called a CDSC. It's a contingent deferred sales charge. What that means is the insurance company is going to keep a portion of that money based on how much you're taking out. They'll keep a percentage. So one of the things you want to be aware of is, how quickly do I need access to that money? Because if I need money in that CDSC period, I could be losing a lot of money and actually losing more than I ever gained in the interest. So just something to think about is, how quickly do I need access, right? Because I want to protect the money, I want to grow the money, but do I actually need access to it? You might be thinking, okay, well, I like the guaranteed interest rate, but why not just use a CD? Because then I don't have a contingent deferred sales charge. I might not lose any money if I need access to it, which is true. One of the things you want to think about is, what happens in an annuity is all the growth is tax deferred, right? So that means you're not going to get that 1099. And if you're trying to cut down or save on taxes later on in life, it might be a good way to protect some of that money, grow it, and not pay taxes at that time.
So listen, if you're 40 years old and the question is you haven't started to do retirement yet, you could start now, and you do it through a proper cash flow analysis. Money in versus money out. What does that look like? Well, if you're going past the match on your 401k, or you just got a job and you have 401k, don't go past the match. If you're prepaying your mortgage, maybe not prepay your mortgage, put that into a separate savings account. If you're overpaying for your homeowners or auto insurance, you could increase the deductible. It's going to give you a savings. You could put that savings somewhere else. If you're going out to dinner, let's say 8 times a month, go 2 times a month. Take the savings and put it somewhere else. And if you properly start doing that now, over the next 10 or 20 years, you'll be able to create more money than you thought possible by properly budgeting along the way.
There are so many different types of annuities out there. And in the realm of fixed, I think about just this one type that gives a guaranteed interest rate, but there's also fixed indexed annuity. There's single premium immediate annuities, deferred income annuities, a lot of different types out there. And one of the things that we've created for you is a free course, all access. Click the link below. You'll be able to get a full education on all the different types of annuities out there. So as you're shopping and looking for, hey, what's the right one for my plan? This will give you a nice guide and have you going in understanding the different types that are out there for you.